Hi everybody, it's time for our first homework assignment. So here I am in our Compass webpage and I'm looking at the week number 1 learning module. We'll find the assignment by clicking through, and here we've got the description of what we're going to do for assignment number 1. And the idea for this assignment is to really just get us used to the process of accessing historical data on Quandl, getting it into Microsoft Excel, and doing some basic charting tools. And as a bonus, starting to think critically about what these price relationships might look like. So let's read the directions for the first step. We're going to go and find data from Quandl.com for the December 2017 CBOT corn futures contract. And we're going to download a CSV or Excel file, and then we're going to do the same for March and May 2018 corn futures contract prices. Now you may be wondering why they're CBOT prices when in our book we learned that the ticker symbol is built by saying CME, December corn futures prices. There's actually a little bit of an aside story there. Corn and soybeans and wheat and most of the grains have historically always traded on the Chicago Board of Trade, and they were a separate entity from the Chicago Mercantile Exchange. But several years ago, the Chicago Mercantile Exchange bought the Chicago Board of Trade. And so there's still such a thing as the Chicago Board of Trade. It's just owned by the Chicago Mercantile Exchange. So sometimes you'll hear people call it by the legacy name when it always has been, the Chicago Board of Trade corn futures contract. But some data vendors like Quandl, for example, kind of lumps everything that the CME owns into things that are labeled as the CME. So you can see them labeled in both ways, and if you know the history of where those names come from, then it makes some sense. If you don't, it can be kind of confusing. So that's just to fill you guys in on where that comes from. Let's go on over to Quandl.com, and if you haven't signed up for a free account with these guys, you'll need to go ahead and do that to complete this assignment. It's a pretty cool resource in terms of having access to a lot of nice free data sets, so I do recommend it. Alright, so let's talk about how to access the data that we actually want. Well, we're going to do that through the conventions and their URL that they use. So the way we can access something like the December corn futures contract is we're going to write a / here, data, and then the rest is going to be really the ticker symbol examples for the Quandl column from chapter 3 that you've probably read at this point. So those look like CME / and then the commodity code. For December corn futures prices, that should be CZ2017. So hopefully this will go through, and success. Okay, so if you landed somewhere you shouldn't have, take a look carefully at your link. You don't need to type all these words. If I get rid of them and check it again, it'll happily reload. And what we're going to do is just download this thing. I'll download the CSV file. And remember, I'm asking for the December 2017 and the March and May 2018. So let's do March first. If you don't just remember that the month code for March is H, you can go back to our chapter 3 and take a look at the table and figure it out. And we want 2018. Notice this is updated from what I asked for in the assignment before, so make sure you pick up on that. Okay, so here's the March 2018 data. I'm going to go ahead and download that as well, and I'm going to get May. So I'm going to get rid of these words, type K, because K is the month code for May, and the 2018 will still work. So here's the data for May. I'll get a CSV file here as well. Okay. Alright, so next thing to do is to open up all 3 of those CSV files. Here I'm looking at the December corn prices file. And we're going to paste them all into one file so we can examine them together. But first, a comment about how this data is sort of organized. You always have a column for the date, and then there's a column for open, high, low, and last, and then the settle price, which is always very close to what the last price was. And you can use these 4 columns to build those price bar charts that we had, or the candle charts. And you can even make those kind of charts in Excel We won't show you exactly how to do that today. There is a way. But we want to just work with one price for each day, and we'll go with the settle price. So go ahead and delete all the columns that are not the settle price column. And I want to, since we're going to paste all these things together, I want to make a note about which prices I'm looking at. So I'm going to type a Z here to denote that this column is the December prices. Now I'm going to navigate over and open up my other files. So let me start with March 2018, and I'll do the same thing. I'm going to delete and delete again, and now I'll copy these two columns over into the Excel spreadsheet with December. And let me make sure we get this matched up correctly. Insert some rows should do it. Oops, too many. Okay, and these were March prices, so I'm going to put an H. We're going to leave the dates so that we can adjust the links at the bottom. You'll see we only go to 12/14/2015 on this contract, but we have more prices there. We'll trim everything up to be the same length at the end. But for now, let's go over and get our March prices. Not the March prices, sorry, that's what we just did. We're going to get the May prices, K for May. It's easy to mix up as you're going along, so be careful of that. Delete, delete, and I'm going to bring these over. Control C, Control V. I'm going to insert a row and label this K. Okay, so like I said, these things are different lengths, and you can see basically the December contract is going farther back in time than the other two. So we're just going to delete the extra so that we have data on all the same dates. So one more time, what I did was I said, okay, the first date in our sample is going to be 12/14/2015, and I'm going to delete everything below here for the December prices. So I'm going to highlight to the bottom of this December price data and just delete it. So now we have this nice rectangle. And now that we have all the dates matching up, I'm going to delete these intermediate date columns. And now we can actually try to plot these things. So first, let me just clean up these column headings. I'm just going to delete this thing, these settle things, because they're not that informative. And then I'm going to move these guys down. Okay, now I'm going to highlight this whole thing, insert a chart, and I'm going to choose this style right here, lines with kinky things. And we get something here that's pretty much correct, but it's not exactly formatted the way we would like. First of all, let's make this thing much bigger. So now we can at least see the dates. And let's modify this axis so that we can see more of this daily variation in this thing. So if you missed what I just did, I right-clicked on the y-axis, and that reveals this menu, and I'm going to choose Format Axis. And now I can say, okay, don't go from 0 to 500, go from 300 to 500, and that'll be a nice range for us to take a look at. All right, so now let's start thinking about what we've got here. We've got December 2017 prices, March 2018 prices, and May 2018 prices. Let's start to think critically about those questions I'm asking you in the homework assignment. So first of all, are the prices equal? Obviously not. Why are they not equal? If they both represent corn, why are those prices not trading at exactly the same value? So at this point, I want you to kind of sit with that for a second, and I'm going to let the video just roll on for a minute. Okay, so they're not equal because while they both represent the expected future price of corn, they represent the expected future price of corn at different points in time. So the December is the price expectation of what the price will be in December, and obviously the March is what the price is expected to be in March, and the gray is what the price is expected to be in May. Okay, so the price of corn fluctuates over time, so it could be that expectations about prices in December, March, and May would be different. The other thing to note about this graph, though, is that they seem to be systematically ordered in the same way. Those lines are not really crossing very much, and probably never if we zoomed in. And it wouldn't have to be that way, right? People are buying and selling and trading in these markets at exactly the same time, and they could bid up the December price over the March price or over the May price. And in fact, that happens sometimes. But most of the time, they're ordered in this way, with the contracts that expire sooner priced lower than the contracts that expire later. What could cause that? All right, so the answer is that since we only harvest corn once a year, then people have to be incentivized to keep it in storage and not just bring it to market all at once. And the futures market helps coordinate that, that timing of bringing stuff out of storage and into the market. So if you have some corn in storage, you can look at these price spreads and say, you know, if I only wait until March, I can get an extra 30 cents or 50 cents or whatever the market is offering. And we'll learn in the next chapter you could even hedge that spread and lock in a guaranteed return to storage. So in general, this is called a contango market. You have nearby prices or less than deferred prices, which are less than even more deferred prices. That usually happens, and we call that kind of market a contango market. And that provides incentive to store and wait until a later date to bring product to market. And if you have stuff in storage and you think the incentive to store offered by the market isn't worth it, then you can just go and sell it right away.